Ladies and gentlemen, I'm sorry. I know I told you all to be back here at 2 o'clock sharp, but fortunately, Governor Noyer was astute enough to realize that we were running late. As I told you, the best parts of a GIC conference are the coffee breaks and the lunches. So, unfortunately, Axel Weber left his speech back in the other room, so he's going to get it. He'll be here in a moment, and we will begin again. Thank you all for coming back. They're trickling in. There's John Sylvia slowly making their way back in. Axel's presentation is going to be on capital requirements and the bail-in, bail-out regime. We'll begin as soon as he gets here. I'll tell him that I already introduced him, and you can all clap. So this is what happens when you don't have David Kotok running the conference. Things just fall apart. I could do hand puppets. I mean, we could.
Sorry.
Not a problem. All right. I've already introduced you to save time. So.
All right. Good. Do you want me to start?
Yes.
All right. Thank you.
The late Axel Weber.
I left my bag in the dining room, so I'm sorry about that. Well, first, let me start by saying how happy I am to be here at the Banque de France, at the joint GIC Banque de France conference in a splendid new venue. Also, I'm not complaining that you hosted us in the Galerie d'Or in the past. That was a good venue as well, but I can see the advantage of this modern room here. During the morning, we have already touched upon a variety of issues, the rise of global protectionism. In my remarks, I'd like to focus a bit on banking, and largely to keep within the subject of the conference, I'm going to talk about increasing national focus of regulators and supervisors in defining some global framework for the industry. This is becoming discussed in many meetings as almost a regulatory nationalism, which I think is overdone as a concept, but I think it highlights the concern many in the industry have about renationalizing of financial systems and basically a risk that the global financial risk system will cease to exist in its current or previous form. So as a tendency, in my view, it is concerning, and there are several negative side aspects that could come from it. Firstly, from a global perspective of a global bank, the need to comply with divergent set of regulatory requirements adds significant complexity and cost to doing business globally. And that is something that my colleagues in the banking industry will continue to point out as they interact with regulators. It also increases uncertainty and in some cases, it delays the necessary strategic decisions. Let me just give you an example. We at UBS were one of the first banks that moved the capital ratios to the new long-term capital requirements. And in changing our strategy and in being one of the first to implement these new standards, we were actually rewarded by financial markets. But there was considerable uncertainty about what the end point of the trajectory was. And I think it helped us to look through that short-term volatility and discussions of the international debate and really focus on what the Swiss has defined as a Swiss finish, which was a 19% capital ratio from which you could get a discount for more resolvability. And I'm going to focus on this resolvability issue because it still is one of the issues that's still being discussed. Second, lack of international coordination and alignment of standards can potentially offset progress made by increasing the stability of the financial sector, which clearly I think has happened so far. There are, in my view, two examples that I like to allude to in this short debate and then open up for discussion, how important an international cooperative approach among supervisors and regulators is to really get a global financial system, assuming that that is still the long-term objective where regulators want to go. And having been a member of the group of the BIS, at the group of the Financial Stability Board, it is very clear that global regulators want a global financial community. The first thing I'd like to discuss is the current discussion about renewed tightening of the capital framework, in particular about a leverage ratio that instead of becoming a floor might become an overarching restriction for financial businesses. And in my view, that is something that I would view critically. And the second one is the development of a global resolution and recovery framework that is still pending. I think it is absolutely needed in order to have the establishment of effective Bailin regimes, to have these regimes aligned, not just in terms of what banks will do when they come to that point, but also in terms of legal certainty and decisions taken in a Bailin kind of framework to hold up in jurisdictions and in courts across the US, London, and in Europe. And that's still an open issue. And I'm being told by many lawyers it will be an open issue for years to come. And so there again, I think we need to move on those two fronts. None of what I say is new. I just want to portray it maybe from a different perspective. So let me turn to the discussion about the renewed reform of the capital framework for banks. In my view, it is undisputed in the financial industry that the financial system revealed the need for enhanced capital positions of banks. And I've always talked about that, like Christian has in his previous discussion, and he's now the chairman of the BIS, about that need to recapitalize the system and work over the financial system. I think it was achieved through an engaged reforms, and I think in my current role, as I tried to say, by moving from being a regulator to being somebody in the banking industry, I moved myself from being somebody who actively engaged in defining and discussing the reform to somebody that in its current role is actively engaging in implementing this new framework in a global systemic bank and being ahead of competitors and viewing more capital and better liquidity management actually as a comparative advantage in the new world rather than reluctantly move into this new world. I'm confident that the Basel III Framework is a major step, and many things have already been achieved. The risk-based approach based on internal models is absolutely, in my view, the right one. It allows for risk sensitivity and it sets the right incentives to reduce risk and to manage risk appropriately in the financial system. And it's complemented by a comprehensive sets of liquidity requirements, stress tests, backstopping arrangements like the leverage ratio. And in my view, Basel III clearly has the right instruments and it will provide more stability. And when I was a regulator, I've always been a fan of these reforms that are now called Basel III. Any of the refinements that on top of this framework are being discussed at the moment need to be looked at in a sense that what is the value added by these reforms and what are the additional risks that are implied by these. In my view, banks need to be clearly focused on managing risks prudently. They should not be distracted from doing so, and they should not be incentivized to arbitrage between rules. And that's where I think a level playing field will come into play unfortunately, we're not always seeing a level playing field in the implementation of the Basel framework when it's translated into national law, despite the fact that the original intention was to have a level playing field standard. I view somewhat skeptical the current debate about simpler measures that, in my view, are not sufficiently risk sensitive, and this is why, in particular, with respect to two measures where I think there is a risk of losing risk sensitivity in the Basel framework, I'm somewhat skeptical. The first one is a substantial increase in the leverage ratio. I think this will be something that, if that is happening, in a broader sense, could become the key constraint on banks' activities. And the second issue that I'd like to talk about is the renewed emphasis on applying the standardized approach or a more standardized approach to risk weights. I think the right way to go is to standardize risk weights in the advanced approach and do all the assessment exercises that the Basel Committee and others are doing, but to go back to a very simple way of assessing risks, in my view, would actually distract banks from looking at appropriate risk management and how they embed risk management into their day-to-day operations. So risk management needs to be very much aligned in how banks run the risk and manage risks in their banks, and that's where I think for large global systemic banks like UBS, the standard approach leaves very little to be desired and a lot to be added. In my view, regulatory measures should also enhance supervision and increased capital requirements in order to improve safety in the industry. A lot of what has been achieved has done that. If I just give you an example, under Basel II, you could actually run the bank on 1% common tangible equity, because the minimum standard was 2%, and there were a lot of capital instruments that were actually recognized without really being fully loss-absorbing equity. Now, for systemic institutions, the new standard for common tangible equity is 10%, a vast improvement to the old 1%. In my view, a complete reshaping of the Basel framework, whilst it's not yet fully implemented, and this could easily happen if the leverage ratio is calibrated wrongly and it becomes an overriding constraint, could actually have negative impacts across various jurisdictions. Targeted enhancements of the framework should be followed, and I think really that is what is needed. A complete overhaul of the framework before the reforms actually are implemented, in my view, would be counterproductive. So I'd like to focus a bit on concrete efforts towards harmonized implementation of the agreed rules and standards rather than adding new rules to the given standards. It's important to enhance transparency and comparability of various institutional risk profiles, and in my view, a sort of overriding constraint of a leverage ratio does not necessarily do that. I think the work that is currently done around the Enhanced Disclosure Task Force is very important. Actually, when I look at how we prepared our annual report for the new AGM in this year, and how much additional disclosures, standardized disclosures, driven out of the Enhanced Disclosure Task Force is in the new report, I think it's actually something that both investors, creditors, and depositors will really appreciate, that there is a new disclosure standard that all of the banks are adhering to. Second one is a set of common standards within the Basel III framework is what is needed, and improving that and aligning it to incentives is, in my view, the right way of continuing with the reform. The recent Basel full text for the leverage ratio, in my view, that was published is a step in the right direction. There are some issues in that report that I think some of the financial industry still look at with some critical remarks, and I can go into that in the Q&A what those are. But I think it's the right step to actually more or less do what just has been discussed in Australia under the Australian presidency, to set the endpoint of the reform agenda and to move to that endpoint to create more certainty about regulation as soon as possible. National supervisors should work closely together to ensure that the agreed standards are implemented in a consistent way, and in this context, the reviews by the FSB and the BIS, I also think, are very, very helpful. Now, when it comes to resolution, I think a lot more needs to be done. Whilst we're largely done with the capital and liquidity standards, in my view, the whole area of closer cooperation between regulators in addressing the too big to fail issue still needs a lot of work to be done. Bank failures should be possible without causing systemic consequences. They should not cause disruptions of critical functions in the bank, and they should happen without further taxpayer bailouts. Now that, as a set of objectives, is worthwhile to pursuing, but actually we're quite away from that. We, as a financial industry, support the development of Bailin as a key tool to facilitate a safe restructuring and recapitalization of the bank. And while in the recent years much has been done, both by regulators and the industry, to establish an effective resolution framework, in some important areas, program is still needed. So if I just tell you a few sentences about our journey. The first constituency that required us to deliver a resolution and recovery plan was the US, July last year. We delivered roughly 1,000 pages. We then rolled that out through the home regulator, Switzerland, and the UK. We've now adapted these plans to cover regions like Singapore, Hong Kong, where we have 3,000 people each, and that standard is now being rolled out through other constituencies. It's a major work to really put down in a plan what you would do if you're in a crisis. But of course, as soon as you've done that, you notice the need for interaction between the various regulators, because you cannot resolve in one constituency independent of the approval of the home regulator or other regulators in key jurisdictions. So the College of Supervisors around systemic banks becomes more and more important. One of the major open construction sites in establishing an effective global resolution regime is exactly that. The key concern in this context is the lack of consistency of and support of a global resolution strategy for GSIFIs under the lead of the crisis management groups. This is a prerequisite, in my view, to achieve improved resolvability of GSIFIs. It avoids excessive local requirements, but unfortunately some of the recent developments have actually front-loaded and finished local standards on resolution before the global standard was finalized or agreed upon, and that creates a challenge. A further concern is the increasing number of jurisdictions that have such established local defensive regimes, requiring substantial increases in self-sufficiency of local operations of GSIFIs in their own jurisdictions without de facto reference of home host corporations or home country commitments. So all of this stuff gets done unilaterally, and then there will be a round of coordination and agreement, but in the interim, the market and global banks will be priced along these divergent national standards. And of course, the feeling in the market is there will be a lot more trapped capital and ineffective capital that is locked up in certain constituencies and cannot be used effectively in a resolution case throughout the holding company. To see such developments in the financial industry actually causes some concern by major stakeholders in the industry. The result is a substantive increase in capital requirements banks might need to hold and might therefore also be hindered in effective resolution if you look at the global level. And in my view, this has the potential for a certain rollback of global finance as regulators and as banks focus increasingly on self-sufficiency of subsidiaries. While I know that from experience, the complexity of an established and effective cross-border resolution regime is problematic, and it needs a cooperation among regulators. It could potentially, if that cooperation doesn't come about proactively, throw us back in basically undermining some of the achievements that have already been there. I'll give you an example where I think a regime that is actually quite sensitive. The Swiss Finnish has a capital requirement of 19% common tangible equity unless the bank can demonstrate it's resolvable. If you can, through active measures, through institutional design, for example, standalone subsidiaries, holding structure that issues debt into the market, no operational units at the holding company, if you can change your structure to a more resolvable one, in the Swiss regime, you can get a discount from that high 19% capital requirement for more resolvability. And I think that's exactly the way to go, to basically provide economic incentives for resolvability, and if more resolvable, to really sort of also give a capital discount on a, admittedly, globally, the highest standard that exists around capital regulation. The 19% in Switzerland is, by the way, comparable to the 10% GSIFI standard that we see in many international banks. So just you get a sense of proportionality. Let me summarize. There is no doubt that the industry and the regulators share a common goal, and this is to strengthen the financial system and the stability and to make it more robust against shock. We've just gone through the deepest financial crisis in post-war history. It could have easily been the deepest financial crisis of this and the last century. So change is absolutely needed. And while substantial progress has been made, and this progress will continue, there are certain aspects of the regulatory framework that need to be enhanced to make it more robust. One is the one of what rules to apply at the global level, and I think there the global resolution and recovery work is of first and foremost important. The second one that I see is don't let us discuss reforming the reform before the reform that we agreed on is actually implemented. We can always improve on Basel III with a new standard if we see some shortfalling of that. But there is the risk that if new regulatory uncertainty is added at this stage, banks will stop implementing and simply wait for the final rules. That is actually not very good because implementing Basel III in its entirety would add a lot of stability. So I'm very much in favor of finishing the regulatory journey that was agreed and then asking questions about do we need to travel further. An uncoordinated approach of regulators in adjusting regulatory requirements at the national level for national interests should be avoided. It will ultimately harm economic growth. It could potentially offset positive effects of what has already been achieved. And in my view, it has the potential to also undermine the global financial system, which in my view is absolutely needed in a global economy that is growing closer and closer together. And you can see that in the morning discussions between the two governors. All of the monetary policy issues, whether it's the United States, whether it's Europe, whether it's Japan or China, are very interactive, very much linked, and so is finance. We can't ignore the fact that finance is global, monetary policy is increasingly global and viewed from a global perspective. So we need to do everything to continue to work towards a global, safe, and financial system. If we have loopholes where the capital or liquidity standards are not fully matched in terms of having lower standards somewhere, the big fear is banks will arbitrage, like they always do and have done in the past. Any financial institution will try and use a non-level playing field to arbitrage activities between the different layers. And that's not a good system, and therefore I would like to see a system that puts global finance first and does all the things that are needed to move to a more stable system. Thank you for your attention. Back to you.
So Axel, as an economist, it's always difficult to argue against a kind of free trade or universal rules environment. So the question is more of a nuanced political one. I mean, you note that you've started to move in the US first and then moved to home market, the UK, then to Hong Kong, Singapore. I mean, is this a function of how fast these countries are moving out of recession and are arriving at final rules? Or I mean, because it seems that crisis leads to the most change. So as the crisis is resolved, you will start to see more stability. I'm just wondering what lead lags you expect in this environment.
So I think in general, there is an element that after the deepest financial crisis, which, again, repeatedly I say, had its origin in the United States, in the most sophisticated financial market of the most advanced economy, in the most complex financial institutions in that market. We're now at a point where the US financial system has actually largely recovered. It's not fully healed, but the banks have largely recovered. The economy is doing much better. It's bordering onto a self-sustaining recovery. And financial regulation has really gone through all the different rule books and has changed standards. So there is an element of recovery being most advanced and therefore banks being able to withstand more regulation in the US relative to other areas. The second issue that I think is more important is these systems for too big to fail or resolution are tailored towards national political systems. And what is problematic is whilst there are some discussions still open at the Basel or FSB level,
some countries are creating the very rules that are still being discussed in international fora and putting them into national legislation. And that's more my concern. I'm not concerned that there will always be some delay between discussing global standards and putting them into national legislation. What I'm concerned about is the lopsided way that sometimes national legislation is designed and implemented before the international discussion is completed. And that creates non-level playing field issue, because it's very hard to see if US legislators pass a set of laws that they would reopen them if the international agreement ends up in a somewhat different place. So for me, it's more the kind of sequence that I would like to see is one, let the FSB and the Basel Committee and the international regulatory scene do their work, and then implement these commonly agreed standards in national laws, and that can happen at different speeds. The concern I have is also one of extraterritoriality. And it was pretty clear in the discussion. I'm just, we're not subject to this debate, we're subject to the regulation. But take the whole discussion between sort of the derivatives market, the CFTC rulings, and how the US law initially was designed is now being implemented at a slower pace. But there was a big extraterritoriality element in the CFTC swap dealer rules that were binding for every constituency globally, including the EU and Switzerland. That is, again, a process that sort of is outside the normal regulatory collaboration, where you first agree internationally on the rule, and then everyone does the rule book according to the implementation of that. So I'm not in principle against sort of some countries taking the lead, but there must then be a second round before the rule book is written to get the international consensus going, so that we don't have different standards and a non-level playing field. That was more my concern. It's more one of sequence and not one of that, you cannot start with a certain set of rules. But swap dealer rules are a good example where rules are incompatible between the European, or at least in the original design, were incompatible for banks between Europe and in the US. And that makes very little sense for global banks that have a fraction of their operation only in the home market, and maybe Swiss banks are particularly vulnerable to that because the home market is 8 million people, and therefore a large part of the operations are outside the home market, in particular when it comes to investment banking and some of the issues more at the core of the re-regulation.
We'll take questions from the audience. Don?
Thank you for an interesting talk. It sounded to me, and correct me if I'm wrong, that we're not quite there yet. We still have some reform and some implementation of the Basel rules that have to be done. Is there a best case scenario for how soon that could be done in years? Let's say, is it 1 year, 2 years, 3 years away, or is it just uncertain at this point?
Well, look, Don, one of the issues that is clearly there is when the regulators decided, and I'm speaking under the control of at least my colleagues from the Banque de France and other constituencies that are here in the room, it was very clear the rules are being phased in till 2019. So there is a whole set of regulatory tightening and standards improvement that's going to happen, already pre-decided but phased in a period that is still ahead for the next 5 years. Of course, we all were aware that the market would require these new standards as soon as possible. Very few in the market now talk about Basel III on a phased-in basis. Actually, what you disclose is Basel III fully applied. Everyone does, because the market wants to see those rules now. I always compared the phasing in a bit to the broom car in a marathon. The cameras are always on the front runners. They're the ones that really count, and in the market evaluations, that's what matters. The broom car is the car that takes those that don't make the sort of end of the marathon in the time that was given by police controls, So if you're too slow in meeting that minimum speed, then you might be actually taken out of the market. And I see some of the discussion about sort of reviewing the solidity of banks along those lines. But very clearly, there's a lot of stuff still in the pipeline. Banks will be a lot more stable once they have reached that ultimate trajectory. And you can always talk about speeding up and front-loading some of that, because it's an agreed standard. If you fundamentally change those standards, I think you are in a totally different game. If you talk about a leverage ratio that will become the overriding constraint on bank capital, irrespective of the risk-weighted and the liquidity measures, I think you're in a new world. And in that new world, you don't necessarily reward prudent behavior, because it's the size of the balance sheet, irrespective of risk, that matters, and that could actually set the wrong incentives for a small balance sheet with high risks, rather than a prudently managed balance sheet. So I'm concerned about these, and a lot of this discussion is in the, in terms of simplification. Well, I'm afraid global finance is not simple. It's complicated. And too simplified approaches may sometimes do the opposite of what they should do, and that is oversimplify the complexity of these systems. And I'd rather have a set of complex issues managed well and risk controlled well, rather than move to a too simple standard that opens all sorts of loopholes, again.
John?
Is there any regulation in work that is addressing the composition of bank boards of directors? Because one of the criticisms of the financial system after the crisis, and I think Henry Kaufman was quite articulate about this, was that these banks with such complex operations, as you just mentioned, had barely any directors on their boards who were qualified to supervise such complex operations.
Well, there are elements of composition and governance that are there. Actually, it's, just to do a bit of self-advertising, I've been sort of in a group of, members of the Group of 30 that published recently 2 reports on governance of boards. And these 2 Group of 30 reports basically dealt with 2 issues. The one is, how should a board of directors run its governance to be best in class? And the second one was more, what are the requirements nowadays on boards of directors to fulfill their duties? And so there's a good survey in these 2 recently published papers on exactly what boards of directors need to do. But let me also point out, it's a bit more complex than just putting all the weight on the board of directors. You actually need prudent management, so you need a set of executives in the bank that manage these well. You need a regulatory framework where reporting lines are tight enough to get a real-time monitoring of what is happening in the banks. And I think on all of these standards, the new regulatory framework has moved forward quite a bit. So the disclosure issues that I talked about very briefly, the enhanced disclosure task force, will make sure that investors will understand much better in the future what are the risks in a balance sheet of a bank than they did in the past. So all of these reforms, I think, like a system, they all sort of built on each other. And I think by the time we've implemented all these different work streams, some faster, some slower, we will have a totally different set of regulatory environments for banks, in particular for global banks that are systemic, than we had before. So I don't want to sort of call victory at this point because it's very hard to do so, but we clearly have in each and every dimension of capital, liquidity, management, risk control, governance, pay related to incentives also, and incentives are very important in the banks. We have had a set of rules that are being designed and implemented in addition to these recovery and resolution plans that I talked about that will make banks safer, each in their own dimension, then hopefully by interacting and multiplying the effects, bank holistically being a lot more stable. I'm pretty convinced that this will happen.
A brief question on the role of the rating institutes in this context. Do you feel that the rating institutes now so far have the skills or the necessary conditions or are able to or have been adapting to these new regulatory environments, or what's the role of the ratings institute in this context, please?
Well, but that's one of the reasons why I talked about the standard approach. I think sort of making third parties' risk judgments the basis of you managing financial risks in a bank is never a good approach. A bank needs to understand and manage the risks they have on their balance sheet through their own lens. And that's why I'm very much in favor of the advanced approach of basically putting banks' own risk judgment and own risk management at the core of how they manage risk. How you then translate that into a regulatory standard for capital and liquidity is a different issue. You know, there you can discuss harmonizing, you can give the BIS and the Basel Committee a role in looking, do banks actually in their own internal risk management come up with similar answers for similar asset classes, and you can, you know, foster convergence of these internal approaches to risk management. But to move away from putting banks' own risk management squarely at the core of how they manage risks, in my view, is a mistake, because we've seen that many unsophisticated investors, and even quite sophisticated ones, in the last financial crisis bought certain asset classes, not because of the risks attached to them in certain states of the world, but because of the ratings that were issued. And the rating agencies have always said, our rating is no surrogate for risk management. It is a view that we express on the riskiness. And actually, when you look at some of the major misconceptions, where credit risk, which had the same metric as risk of structured finance products, it was the same metric that was used. But it was completely forgotten by many investors that credit risk does have completely different risk and return features in various states of the business cycle than, for example, structured finance products, who had the same metric but a completely different liquidity dimension when the liquidity in the market dried up. So I'm not among those that blame rating agencies. I think they do a job. They basically provide a view on certain products, but they never have said in the past that that view should be used by investors to manage risks. I think that is actually not the way you should manage risk. We have some investors here in the room who probably look at their own risk metric a lot more than at ratings. Ratings are are part of the information you process when you talk about financial risk and how you manage them. It shouldn't be the sole information.
Yes, we seem to be in a first in, first out accounting process here. You mentioned in your speech that the United States banks seem to be recovering now. My question is, to what extent do you think that slow GDP growth, notably in the European Union, is due to the adjustment process of banks getting up to the Basel III capital requirements? If there is a restraint on credit expansion, when do you think that that constraint will be removed? And what do you think in terms of potential, if that's the case, of the multiplier effect on investment and growth in general?
Okay, interesting set of questions, all related. Well, let me sort of concur with the first part of your sort of implicit assertion, that is, the banks in the US are clearly more advanced in terms of their balance sheet and capital ratios and meeting liquidity standards, largely because the US financial system has only a certain fraction of the weight to carry when it comes to the US investment cycle. Just compare the two systems. I would always make the point that if you compare the leverage ratio between a US bank and a European bank, you're almost comparing apples and pears. The first one has to do with the fact that IFRS, relative to US GAAP, allows for totally different netting procedures of your trading book exposures. So very hard to compare those numbers. The second one is, with securitization markets broken down, most of the European banks have all the primary exposures on mortgages and credits sitting on their balance sheet, where, for example, just on the mortgage markets, a lot of the US mortgage exposures are not within the banks anymore. They're with Freddie and Fannie and with the Federal Reserve as a result of the mortgage-backed securities program. If you give European banks a European Freddie and Fannie, their capital ratios and their leverage ratios will look totally different, because, with securitization markets, that was a more level playing field and they were more comparable. With the demise of securitization markets, it's very hard to compare these two types of balance sheet. And the third one is, Europe is by 70%, investments are funded through banks' balance sheet. It's a bank-based system. The US, just the opposite, is a capital market-based system. And 70% of investment funding is through capital markets and through access of capital markets. If you compare the role of banks in transmitting and in passing on monetary policy impulses, Europe is still impaired. Credit aggregates are coming down, and the role of credit origination in Europe through the banking system is still impaired, by and large. more so in peripheral countries than it is in the core of countries. And Christian Noyer, the governor of the Banque de France, spoke briefly about that. In the US, the need for banks to be completely back to help fund investment is not as strong as it is in Europe. And if Europe now moves to a system where actually credit origination and leverage ratios become an even more overriding constraint on banks' balance sheet, they undermine the very ability of banks to originate credit in the future, because they still have a lot of old credit exposure sitting on their balance sheet, and the healing process will take longer because we don't have that capital market system that can provide investment financing. And there are actually 2 or 3 areas where Europe and globally, you've seen the new standards take a big impact. Infrastructure investment, very hard to finance at the moment, given the high capital ratios required for long-term investment financing through a bank's balance sheet. And the second one is infrastructure financing, sub-sovereign debt programs. Very hard to do. Some development programs, some development banks still do it. The core of banks doesn't do that as a profitable business anymore. And so there are a number of challenges that are different between the US and Europe. When will that be removed? Very hard to say. I said it a number of times. Before you have a restart of securitization markets in Europe, and we should start with plain vanilla securitization, not complex derivatives. Plain vanilla securitizations. If that market is not restarted, it's going to be very, very difficult. Give you an example. Covered bonds actually did quite well throughout the financial crisis. Now, there's only a set of limited exposures you can actually put in a covered bond. Is usually sub-sovereign debt exposures, so it's credit at the sub-sovereign level, or there are some mortgage products, mortgage securities that you can put in there. But for the plain ABS market to come back, if that doesn't happen, it'll be a long time till banks' balance sheet have improved. My guess is, since everyone works towards the 2019 deadline in European banks and wants to front load that, it's very hard to see how they can beat that deadline tremendously. Actually, this year, the asset quality review and the stress test by the European System of Central Banks for the major players will provide some more transparency on banks, and it will also provide incentives for banks to recapitalize faster and sell down some of these exposures, because if a exposure in some of these areas with a high risk weight is multiplied with a stress factor, it actually makes the bank's balance sheet look weaker. Multiplying 0 with a stress doesn't really harm you. And so I think a lot of banks will try and push that number towards 0 in terms of legacy exposures. And it still will be a multi-year process. So I don't think that in terms of coming back to credit origination, we will see that soon. There's another element, just to finish on that. In Europe, it's not just credit supply. In Europe, it's also, to some degree, credit demand. There's a parallel feature in the US. A lot of corporates are sitting on record high cash balances, largely because they don't put those cash balances back to work, because there aren't the investment projects and the demand for those products that would warrant investment at this point in time. It's not much different in Europe. So it's not just all credit constraints in the banks, supply side constraints. It's also credit demand for certain projects that have desirable risk-return profiles. There's a lot of demand for highly risky projects, but the risk weights simply don't warrant the returns you would get on that business. So the system needs a couple of years to heal.
Paul?
Yes, may I ask you an indiscreet question? You, as a German regulator and CEO of a major global TF, is the question of bail-in or bailout covered in your 1,000-page resolution document, or do you think it should be?
There is no bailout discussion as such, because you can imagine in a constituency like Switzerland, where the banks had to, or at least UBS had profited from taxpayers' money, both in terms of an equity injection and in terms of a legacy portfolio that was put on an exit company. There is very little appetite, zero appetite to do it again. So our global resolution regime covers more the bail-in discussion. But before that, it's actually resolvability. And resolvability has to do with the fact that you move to a system where basically through service companies, systemic functions are not just rested in one entity, but they actually serve the bank across various entities. So you really need to take institutional and legal steps towards resolvability. We, for example, believe that the most viable model for bailing in is a single point of entry model rather than a multiple point of entry model, which means that ultimately you have to reshape the holding structure to have subsidiaries that are the units in which business is done across constituencies and across business lines, and then you have a strategic holding ultimately above those business units, so that when you have a problem at one of the subsidiaries, these subsidiaries could issue, and that's a proposal we made to the US Federal Reserve, could issue intragroup debt to the parent or the holding company, and then the holding company would issue into the market and would, if triggered, have to decide whether to put in new capital or to bail in. I don't think bail-in is the sole decision that a group holding company should be able to take. There should be other forms like rerouting capital within the company or selling subsidiaries in order to stand behind important subsidiaries that you want to keep within the holding. And the single point of entry allows you to do a number of strategic checks before you go to the bail-in decision. A multiple point of entry regime very often leaves you the bail-in as the sole, almost the first option to draw on, and in my view, that is not as good as a single point of entry regime. So we're actively thinking about these. Bail-ins play a bigger role, almost the exclusive role, in terms of the option when it comes to providing capital from third parties. We don't rely on taxpayers anymore in our regime. We want to move to a system where the bank, out of its own strengths, can resolve itself. And I think that should be the ultimate target.
Steve?
So, as you mentioned, investors and rating agencies, and I thought I'd amplify that point with a perspective from someone who actually spent time modeling these companies at one time in his career and talking to the, Karen's smiling, talking to the rating agencies as well as the analysts, and here's the truth is, they don't know much more than we know. They're just regular people trying to figure things out, and we literally would mail spreadsheets back and forth with detailed models. Karen shaking her head. So it's just human beings trying to guess as to what's happening. So I think, just to amplify what Axel said, is to rely on that as an absolute is folly. Second point would be, we are sensitive to changes. So when you have this group of people analyzing something and they all decide to go up or down, that means something good or bad happens. So we're hypersensitive to the changes, not the levels. And then I think the third thing is there's a lot of regulatory gaming. So if I'm a money manager, I can buy short term, and my governance is I can only buy AAA and above, I want to encourage people, even if they're not AAA, to get rated AAA. So there's a lot of regulatory gaming, and this goes to something I think President Plosser's made the point, is you want lots of competition and lots of transparency. Because as soon as you don't have that, and you have the herds on my side of the fence relying on these ratings, then you get this buildup of eventual catastrophe. Because you just don't know what's happening, and you can assign evil intent, but I don't think they had evil intent. They're just, they're just running their businesses, they're competing, and we're all following them. But there's just no way to know, one person, one agency, what's happening in companies as big as UBS or Goldman Sachs or BNP Paribas.
Karen, did you want to add to that?
No.
Good.
But I will say that from a credit standpoint, we do, and this is like too many years in the past from my career to remember really, we did internally, we looked at individual items, we run our own analysis. And traditionally, we used the rating agencies as touchstones to see how we actually compared to what they were thinking about in their the way they actually have done ratings in a multitask team environment. So that's how we had interfaced with, on a traditional basis, with the rating agencies and used them. So yes, it's very much a collaborative effort across the whole board. And no, we make mistakes, and not everybody, especially with the banks the way they've grown and become so large today, it's really, in my opinion, not possible to know exactly what is going on across the entire spectrum of what we call a bank, especially in the United States.
You've touched upon issues relating to it, but no one has mentioned or asked you specifically about the so-called Volcker Rule and the impact it's going to have both on your operations in the United States and elsewhere in the world.
I think the Volcker Rule is a good example because as an American you would call it the Volcker Rule, as a European you call it the Liikanen Rule, and as a British you would call it the Vickers Rule. And I think once debates like that have happened in Switzerland and in other countries, there's a country name for each of these rules. And the problem about that is that whilst the general discussion is one that I could easily sit back and say, for us, a rule that focuses on stopping proprietary trading by banks won't touch us at all because we stopped proprietary trading 2 years ago. So, but that's not the core. The core is not just proprietary trading. The core is more what actually is proprietary trading. What activities count as proprietary? What activities are market making, which should actually be there to provide liquidity in the market? And that's where these rules become very, very complicated. And also, the separation that is being discussed is a different one across constituencies. For example, in the UK, the whole Volcker Rule is more a ring-fencing debate about ring-fencing retail activity. And again, I could lean back because, and you know, I'm seeing some of our Salt Lake City people sit here, but I was just going to say, outside Switzerland, we're not retail except for Salt Lake City. But really for us as UBS, we're just retail in Switzerland. So if it's about ring-fencing retail activity from other activities, it's not a major issue for us. The question really becomes, how do you look at wealth management? How much of the affluent or that kind of business is actually requiring a retail license, and to what degree is wealth management in or out the scope of this of the U.S. The U.S. intermediate holding company puts wealth management into a separate bracket to retail, and the brokerage business is dealt with somewhat differently than retail business. Again, you know, all of these rules are differently around, but it's a good example where actually some more coordination among regulators would help to have a targeted debate, because if we end up as a global bank to have a intermediate holding company in the US with an investment bank and a broker-dealer as subsidiaries, if we end up with a UBS Limited in London, again with a different structure, the whole impact of these regulatory rulings in different constituencies become more impactful for the way the bank organizes itself than strategic or business decisions that you would take in optimally finding the best way to run the business across the globe. And so these are important discussions. I think in terms of the Volcker Rule, we will have a US intermediate holding company, we will have 2 units in that, and we will move to more self-sufficiency in terms of local capital and local liquidity and booking assets locally in the United States.
To follow up a little bit, though, you say there's a need to have a discussion. What governmental or professional entity or trade association do you see leading that discussion?
I think this discussion will ultimately go back to the FSB. And I think Mark Carney and the Financial Stability Board will be the ones that are tasked by the G20 to make sure that as rules get implemented in national laws, there is a common thread throughout these national legislations. And I think what they will do in a second round is revisit the national laws and then take up issues where a level playing field is not ensured by different implementations of a general regulatory global guideline from the G20.
Well, we'd like to thank Axel for a scintillating conversation, very insightful on the intricacies of the international banking environment today. We have a brief break now for 15 minutes, and then we will return for Japan now and tomorrow at 3:15. 3:15. Don't be late.